Good morning, this is Dan Mellis with Diamond Residential Mortgage for Friday, June 27th, 2014. It's been a busy week in the markets. We're looking at, on Tuesday, we had a GDP revision revised down to negative 2.9% GDP. Those are bad numbers. Anyway you slice it, whatever the excuse, those are bad numbers. And the bond markets reacted very positively for that. Remember, low growth equals lower interest rates. Generally speaking, that's pretty well correlated. So we've seen some nice moves in the bond market this week, very nice moves. And technically, the market looks very, very attractive. It looks like we're going to continue to see lower rates, at least test the May 29th highs that were made in the FNMA. I ran some technical indicators on the RSI, the Wells Waller RSI indicators. When we get to about 70 or approach 70 on the RSI, the 14-day RSI, that's when we're overbought and we ought to be looking to lock. Right now we're at 56.91 and rising, and that's a very attractive sign. Now, also, we cleared an important overhead resistance level yesterday and continued higher today. So we're currently trading at 102.81, and basically we're looking at resistance from the May 29th highs at 103.38, which is about 50 basis points higher than where we're at today. So we are also seeing some portfolio rebalancing on the part of portfolio managers. It is the end of the quarter, so we are seeing a little bit of sell-off in stocks, a little bit of strength in bonds, a little bit of bond buying to rebalance those portfolios. The big news of the week, obviously, was the GDP number, but that was also followed up yesterday with personal spending numbers that came in weaker than expected. Expected a 0.4% increase, came in at 0.2%. And then really the big news after the GDP numbers came out was the news coming out from James Bullard of the St. Louis Fed, and he was on CNBC as well as Bloomberg, saying, we have links in the email, saying that he felt that the Fed was much further along than the markets were giving them credit for, and he was sticking with his forecast of an interest rate hike, small interest rate hike, I would imagine, starting in first quarter 2015. So basically looking 9 months down the road, anywhere from 6 to 9 months for that first interest rate hike. And that's definitely not priced into the stock market right now. So it's going to be an interesting period of time to see how the Fed extricates itself from this quantitative easing program and how that affects especially the stock markets going forward. But we'll get to see that show in about 9 months. That's about it for this weekend. I hope you have, or for this week, I hope you have a great weekend, and we will talk to you next Friday. We've made some minor revisions. We're going to be sending out this update on a weekly basis every Friday going forward. So hope you enjoy it, and if you have any suggestions, please drop me a line. Talk to you soon. Bye-bye.